Money Master the Game by Tony Robbins, a WealthWorks summary. Introduction. Money Master the Game. In 2014, Tony Robbins published a book that was not really a Tony Robbins book. It was something more unusual, a journalist's account of what happens when you spend years interviewing the world's greatest investors and ask them to share everything they know. Robbins interviewed 50 of the most successful financial minds in history: Ray Dalio, Warren Buffett, Jack Bogle, Carl Icahn, Paul Tudor Jones, Mary Callahan Erdos, and dozens more. He asked each of them the same question: if you could not pass your wealth to your children, but could pass them a set of rules, a playbook, what would it contain? Money. Master the Game is the synthesis of those answers. It is long, nearly 700 pages, and at times sprawling. But beneath the length is a genuinely useful framework. 7 steps that, taken together, give any individual investor a complete roadmap from financial confusion to financial freedom. Robbins is not a financial advisor. He is an extraordinarily effective communicator of ideas. This book brings the insights of the world's greatest investors to an audience that would never read an academic finance paper or a technical investment manual. That is its gift. It translates elite wisdom into accessible action. Chapter 1. The most important financial decision of your life. Robbins opens with the decision that matters more than any stock pick, any investment strategy, or any market timing: how much of your income you save and invest. Not what you invest in, how much. He uses a vivid example. 2 people earn identical salaries over their working lives. One saves 15% and invests it consistently. The other saves 20%. The difference in final wealth is not 25% greater. Due to compounding, it is dramatically larger, often double or more, depending on the time period. The percentage you set aside is the lever that determines everything else. Get it right, and almost any reasonable investment strategy will produce good results over time. Get it wrong, save too little, and no investment brilliance can compensate. His advice: automate the decision. Set your savings rate so that it is transferred automatically before you ever see it. The percentage should feel slightly uncomfortable. If it feels easy, it is probably not high enough. The action: calculate your current savings rate, the percentage of your after-tax income that you invest every month. If it is below 15%, commit to increasing it by 2% this month, then 2% more in 6 months. Chapter 2. Become the Insider. Know the rules. Robbins devotes a long section to what he calls the financial system's hidden rules, the ways in which the industry's incentive structures work against individual investors. He covers many of the same ground as Bogle: fees, active management, underperformance, and the compounding cost of small annual charges. But he adds something Bogle does not emphasize as strongly. The 401k and defined contribution pension system was not originally designed to be the primary retirement vehicle for most workers. It was a supplement. The shift from defined benefit pensions to defined contribution plans over the past 40 years has transferred enormous risk from employers to employees, most of whom were not prepared for it. Robbins argues that understanding this history is not just interesting, it is empowering. When you understand why the system is structured the way it is, you can navigate it more intelligently. You can choose low-cost options, you can avoid the worst products, you can advocate for yourself. The action: review every investment option in your workplace retirement plan. Calculate the expense ratio of each. Select the lowest cost index fund options available. If your plan has no low-cost options, that is worth raising with your HR department. Chapter 3. Make the game winnable. Define your number. One of the most practical chapters in the book. Robbins argues that most people have no idea how much money they actually need to achieve financial independence. They have a vague sense that more is better, but no concrete target. He walks through the mathematics of financial independence, how to calculate the annual income you need in retirement, how to determine the lump sum that would generate that income through investment returns, and how to build a realistic plan for reaching that number. The core calculation is simple. If you need $50,000 per year in retirement and you can safely withdraw 4% of your portfolio annually, you need a portfolio of $1.25 million. If you need $100,000 per year, you need $2.5 million. This is the 4% rule, popularized by William Bengen's research and subsequently refined by the Trinity study. Knowing your number transforms financial planning from an abstract aspiration into a concrete goal. You can track progress. You can adjust your savings rate to reach it sooner. You can model different scenarios. The action: calculate your financial independence number. What annual income would allow you to live the life you want? Divide that by 0.04. That is your target portfolio. How close are you? Chapter 4. Asset Allocation. The most important investment decision. Robbins quotes Ray Dalio repeatedly in this section, and for good reason. Dalio, the founder of Bridgewater Associates, is one of the most successful investors in history, and his central insight is that asset allocation, how you divide your money between different asset classes, matters far more than which specific securities you own. Dalio's all-weather portfolio is the centerpiece of this chapter. A portfolio designed to perform reasonably well in any economic environment: inflation, deflation, growth, or recession. It allocates 30% to stocks, 40% to long-term bonds, 15% to intermediate bonds, 7.5% to gold, and 7.5% to commodities. The allocation is designed to balance risk across different economic conditions rather than to maximize return in any single environment. Robbins is not prescriptive. He presents several portfolio options from different experts, but his core message is consistent. Your allocation matters more than your stock picks. A diversified, balanced allocation that you can hold through volatility will outperform most attempts at clever security selection. The action: look at your current portfolio allocation. What percentage is in equities, bonds, real assets, and cash? Does that allocation reflect your actual goals and risk tolerance? Or does it reflect whatever you happen to buy at various points without a plan? Chapter 5. Create a lifetime income plan. Robbins distinguishes between the accumulation phase of investing, building the portfolio, and the distribution phase, actually living off it. Most financial advice focuses on accumulation. Relatively little focuses on what happens when you stop working and need your portfolio to generate income reliably for potentially 30 years. He covers several strategies for generating reliable lifetime income. Annuities, controversial but offering genuine longevity protection; dividend-generating portfolios, rental income, and systematic withdrawal strategies. He is particularly thoughtful about sequence of returns risk, the danger that a sharp market decline early in retirement, when you are drawing down the portfolio, can permanently impair your ability to sustain withdrawals even if the market subsequently recovers. His practical advice: enter retirement with a cash buffer of 1 to 2 years of expenses outside the investment portfolio. This prevents the need to sell investments at depressed prices during a market downturn in the early years of retirement. The action: if retirement is within 10 years, begin modeling your distribution strategy. What will you draw from the portfolio each year? In what order will you draw from different account types? How will you handle a 30% market decline in year 2 of retirement? Chapter 6. Invest like the ultra-wealthy, the secret of the billionaire's playbook. Robbins asks, what do the world's most successful investors have in common? He finds several themes. First, they do not lose. Every great investor Robbins interviewed placed the avoidance of catastrophic loss above the pursuit of extraordinary gain. They all understood the mathematics of recovery. Losing 50% requires gaining 100% to break even. Second, they seek asymmetric risk-reward. Paul Tudor Jones described his ideal trade as one where he risked $1 to make 5. Most of the time he is wrong, but being right occasionally more than compensates for frequent small losses. Third, they diversify across uncorrelated assets, not just stocks and bonds, but assets that move independently of each other, so that when one falls, others may rise or hold steady. Fourth, they are tax efficient. The wealthy spend significant effort ensuring that investment returns are kept in the most tax-advantaged structures available. Returns are what you earn before tax. Wealth is what you keep after it. The action: review your portfolio for tax efficiency. Are you using all available tax-advantaged accounts, retirement accounts, ISAs, or equivalent structures in your country? Are your highest returning assets in the most tax-sheltered locations? Chapter 7. Just do it. Make a decision and take action. The final chapter is the shortest and the most direct. Robbins has spent 600 pages giving you information, frameworks, and strategies. He ends with a reminder that information is worthless without action. He addresses the primary reason most people fail to act on what they know: fear. Fear of making the wrong decision, fear of losing money, fear of looking foolish, and the comfort of inertia. The sense that doing nothing feels safer than doing something wrong. Robbins pushes back firmly. The cost of inaction is enormous. Every year you delay starting to invest. Every year you leave money in a low-return account. Every year you pay high fees without questioning them. These are not neutral decisions. They are decisions with measurable consequences that compound over time. Decisions are made in moments. The decision to automate your savings, to open an account, to move into low-cost index funds, each of these takes an afternoon at most. The financial returns last a lifetime. The action: identify the one financial action you have been putting off. Open the account, set up the automatic transfer, move the money into the index fund. Do it today, not this week, today. Key quotes. The secret to wealth is simple. Find a way to do more for others than anyone else does. It's not what we get, but who we become, what we contribute, that gives meaning to our lives. Complexity is the enemy of execution. The financial markets are designed to transfer money from the active to the patient. Don't wait to buy. Buy and wait. How to apply this? Start with the core lesson from money. Master the game. Robbins opens with the decision that matters more than any stock pick, any investment strategy, or any market timing. How much of your income you save and invest. Not what you invest in, how much. Work through each principle in order. Do not try to implement everything at once. Pick the single most impactful action and begin there. A note at the end. Money: Master the Game by Tony Robbins is a book worth returning to. The principles it contains are not complicated, but they require consistent application over time. Financial success is not a single decision. It is 1,000 small decisions made repeatedly in the right direction. This has been WealthWorks. If this was useful, subscribe. There is more where this came from. Kunadabusur, Edward Furananandinium,